For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future. This is Managing Your Financial Future. Welcome back, Cotter. Another show I didn't watch as a kid. Professor Plum, hi.
I saw a few episodes. Hi, how you doing? And I'm not one of the go-tos in that time frame.
No.
Not in reruns at all.
Yeah,
I don't even know if it is.
I just hated it. I don't know why. People loved it, remember? And the theme song was good, but other than that, it just, anyway.
Not my style.
Not mine either. Boy, we got some stuff to talk about today, Professor Plum. I'm going to keep this as light as possible, and we're not going to get into any textbook stuff, although a couple of definitions may be in order here. But we've got to talk about this. We have seen over the last, since really the end of 2021, we saw 2022, the stock market really didn't cooperate the way it had over the previous
couple years,
or really over the previous, you take away the COVID thing in 2020. I mean, really over the previous 15 years.
2018 was, but that's not a fair statement, I don't think, because there were downtimes just because it generally was up and it felt like it was up, and especially when we look back on it, we feel like it was up. There were down times during that period of time, just not a 20% downtime.
Well, not a 20%
There was like
downtime.
a 19% downtime in 2018.
It was at the end of 2018, but it didn't last long.
No.
This one lasted a full year, and it felt, the one in 22,
Well,
right?
2022 was a return back to, it can go down.
It was the wake-up call. And then 23, we've seen it come back. In fact, I think toward the end of 23, it reached near record territories. Anyway, that's not the point of this. The point is that it was a roller coaster ride from the end of 2021 through the end of 2023, especially in 22, as people were not used to the markets going down. And this got me thinking about something that I think people get they get confused about, and that has to do with risk versus volatility. Now, I think if you ask almost anyone who is not part of the whole financial planning game, or just the average person on the street, and you ask them, what's worse, risk or volatility, they might say, they're both bad. But Professor Plum, there are differences between the two. Would you agree?
Yes, very much so, yes. And I will break it into, it may not be where you're looking to go to, but risk is something that we look to control. Risk is something we do have some amount of control over. Volatility, and that's specifically talking about the stock market.
Yes.
Volatility, we have absolutely no control over the volatility of the stock market. We do have control over how we use that volatility and accept or discount the risk that is inherent in that volatility working against us. The volatility we can't control. The risk is we use it incorrectly.
Well, and that's what we're going to talk about here in this particular episode, and how you might be able to manage them. Now, that was your definition. Mine was a little more textbooky than that.
Oh, of course.
It was that the risk is in speaking just of investments, the risk would be the probability that an investment is going to result in some type of permanent or long-lasting loss of value. Like you put your money into this stock or whatever it is, mutual fund, and you never get your money back.
Right. So you're talking about an individual stock that goes down in value,
or
and
fund.
doesn't come back.
Any investment.
So there's two ways to look at this. Okay, finish your definition.
And then volatility would be how rapidly or significantly that investment tends to change in price over a period of time. That's the sine wave that you see. How quickly is it going up and down, and how much is it going up and down? Not necessarily risky. That's how I'm looking at it.
Going up and down, the markets do that all the time.
Yes.
The risk is that you use that volatility inappropriately. That you invest into something and it goes down. Something that goes down, that is volatility. That's not necessarily at risk yet.
Correct.
The risk is that I have to sell it when it's down.
See, here you go. Now we're jumping ahead, but this is good. This is good. This is a peak of where we're going.
And we have to have volatility in the market to be able to get some kind of return better than than T-bills and things.
Well, that's it. Now, risk, see, people
I want to take one other step.
Yeah.
Volatility is not risk in itself. It's how we use it, because the risk is that we use it inappropriately, as before. Because let's take a 30-year-old and that volatility of the market. And what we would consider bad volatility is the market is down, right?
Yeah.
That would be
negative
volatility. Market goes down. Is that a bad thing? Is that a risky thing for a 30-year-old who's put money into his 401k every year for the next 10 years, 20 years, 30 years? No, that's a great thing. That's not risk. That's opportunity. That's incredible. But you take that same downturn in the market and a 65-year-old who now wants to use that money to live off of, that's a bad thing. That's bad. That's risk. That's negative risk. It's the same exact volatility. One time it's an opportunity. One time it's detrimental to your health, financial health. So volatility is something that's out there. Risk is us being stupid or taking advantage of what we're basically given.
See, and that's where I was going. Boy, are we on the same? We're on the same page. It's said, and I've looked this up, what people have said. If you ask it to define risk, ask the internet to define risk in investments, and they say risk is the chance that your investments are going to decline in value. But that's really not true.
That's decline in value, and then you have to sell them.
The risk is really the chance of your investments declining in value at the very moment you need the money. That's
right.
Risk.
That's risk,
and that's what you're saying.
Yes, because the markets decline in value at some point every year. Some degree. I mean, if you ever look at a chart, I was looking at a chart where it shows the annual return from the market every year, but it also shows the worst portion or worst part of the year. How much was it down at some point during the year? And almost every year, even the years that were up 20 and 30%, there was a point in that year where it was down 10 or 15%. So, like I said, volatility happens. The problem is if I have to sell out when either the market is down or my investment is down in value, that is the risk that I take with using volatility. Because with volatility also, there's positive volatility, positive results. And so to get that better rate of return, we want to use that volatility. We want to use the stock market. But the risk is that I time it inappropriately. And the risk is that I end up getting less back than I put in or than I expected it to come back.
Risk is what will endanger your nest egg, your portfolio. But volatility, Professor Plum, gets all the headlines. Look at any business channel. Markets swinging, look at this. Markets have declined, 20%. We're in bear territory. Look, that's what gets all the headlines, as if it never happens before.
And there's always something new that affects the volatility. Mm-hmm. And so it's a new market. We've never been in this before.
Yes,
we've never seen this before.
Yes, you have.
Okay, maybe you've never seen this particular issue, but we've seen market volatility. We've always had market volatility, and there's always been something that comes out of left field that affects the market, whether it be short-term effect or a little bit longer-term effect. It is nothing that the markets haven't seen really before, even though it's something that is maybe new in our psyche.
It's the cause of the volatility that we generally have never seen before. First, just go back over the last 20 years. 9/11. Well, boom. Look what happened. .com crash. Let's look at that. Then you had 9/11. Then you had the credit crisis. You had the 2008. Mm-hmm. Then you had the downgrading, and then you had the COVID
and the tsunami that affected the markets.
But there's all this stuff. Okay, but it created volatility. Volatility was always there. It was just the cause that was different. And you will not be able to predict the next cause.
But volatility also creates opportunities, as I said before, for somebody who's saving into it, for somebody who has money invested in the market. They should be looking to take advantage of the positive volatility. Positive meaning it's up more than expected. Problem is, most people, when the markets are up more than expected, they're never going to sell at that point.
Because they're watching the headlines that's screaming, look at the markets, they're up, and everybody wants to jump in. And again, that's the volatility getting the headlines when they're not paying attention to the risk.
And in that downside market, that is a great opportunity for people that are buying into the market and that want to try to accumulate for the future. So there's a difference between investing for the future and using the market for my immediate needs. Those are completely different, and the risk characteristic is completely opposite.
So we have to manage what we can manage. You said we can't manage volatility. You're right.
We
It's
cannot
gonna be
affect
there.
it.
You can't affect it any more than you can affect the weather. Really.
I cannot change what the market's going to do tomorrow. And I don't know anybody that can.
Well, there are people who can, in a sense, if the Fed chairman comes out and they say, "Hey, I'm going to cut interest rates by, or
I don't
I'm going
actually
to raise
know him,
interest
so I'm going to
rates."
say I don't know anybody that can. I don't know the Fed chief personally.
Well, I understand, but there are things like that
Right.
where one person can have an effect, but
whatever
we
he
aren't
says, that tends to be also fairly short term. Also, but yeah, the news of things like that, and what other countries, wars, and they can all have effects on the market, but I don't know what the Fed chairman is going to say tomorrow.
No, we don't. So that's why we cannot control it.
I don't know what wars are going to happen or not happen tomorrow.
So let's talk about there are a couple different kinds of risks, how we manage them. First of all, there's if you want for just somebody who's saving for retirement, because we'll keep that on this. There's longevity risk, meaning that you could live so long that your money runs out. Professor Plum, what can you do? Or you live too short, by the way.
There's all kinds of risks. Yes, there's medical risk. There's longevity risk. There's a risk that you die too soon. That you can cover with life insurance and other things. There's a risk that you live too long. These are not market risks. These are personal relationship risks, and that you can shift that risk. There's the risk of long-term care. There's a lot of risks out there.
Sure.
And what you choose to cover or not cover, there's usually some form of insurance or strategic planning that allows you to mitigate some of that or all of that risk.
Yeah. And when you confuse volatility with risk, I think you inadvertently create extra risk for yourself, because you see the volatility, you say everybody's running, I'm going to sell at a loss. I don't care. Get me out of the markets. And that actually does create problem.
Right. Risk is how you accept, how you manage, how you, whatever you do with how you react to the volatility.
So you have market risk, but okay, is the stock market risky? Professor Plum, here comes the famous answer that we use all the time.
It depends.
It depends. Now, explain
what time
why.
horizon are we dealing with?
There you go. It's time. Would you say time? We've said this before, that time tends to mitigate risk in the market.
Yeah, we can't guarantee what the future is going to do, but so far in historical terms, and the reality is the markets over time go up. Not straight up. Not nice smooth line, not a nice upturning curve on the graph. It's a jagged EKG with an EKG that tends to move higher over time.
Well, it is when you've zoomed in, it looks like an EKG. When you zoom out over the course of 30, 40, 50 years, it actually looks like a straight line.
Yeah, the longer you go,
sure.
it is more like that.
Yeah.
But most of us, even though we want to think long term, we're still human and we're still emotional, and we watch the short term. And so how do we manage the risk of that volatility that we know is there?
What are people concerned about, Professor Plum, especially in retirement where you really don't have the income? You don't have a job. Let's say you don't have,
where your portfolio is your lifeline.
Your portfolio is your lifeline, correct. How do you manage that? Because for many people, they just panic and they go back to work.
Well, and a lot of people go by and they listen to what the supposed experts talk about and how to manage a portfolio. And we do want it, just like anything in politics, anything else, we want to hear what we want to hear. We want to hear that it's easy. We want to hear that we can do this. We can get a high cash flow distribution. We can get, and not have to worry about it. I was listening to a very famous individual who I used to have a little bit more respect for. And he came out a couple months ago talking about, what are you doing, talking about 4%? The market's average 10%. Take 6-7% out every year, and you'll still leave 4% in for inflation. You'll be fine. It's like, wait a minute, it doesn't work that way. And so, but we want to hear that. We want to hear that we can have high return, safety of principal, low volatility, tax free, with all in one event. It doesn't happen that way. Well, but we so desperately want to hear it that we would believe it, even though it really doesn't make sense.
But don't people come to you as an advisor and they would say, look, here's, you want to know what I want? I'm here to sit with you, Professor Plum.
Yes.
You're a CFP professional. You're a certified financial planner. Okay. So I want you to, here's what I want. What's most important to me is that I have cash flow that I cannot outlive, or at least cash flow that's, I don't have to worry about, is it going to come to me this month? Okay. I also want to have my savings last as long as possible.
I don't want to run out of money.
Yeah.
I want to be able to do what I want to do when I want to do it and not have to, A, stress out about the market, B, run out of money.
But how often do they come to you and say, I'm retired and I'm 70 years old and I want my, portfolio to I want to take withdrawals and get, 15% rate of return every year. I mean,
well, they say that once in a while, but never twice because they don't stick around.
So
because
you have
that is not somebody that I can work with because it's unreasonable.
All right. So you when you have somebody who doesn't want to run out of money, all they want to have, for the most part, is cash flow that they can't outlive.
Right. And so
this is how you.
So there's different types. There's a person that comes to a planner before they retire. And so they have an expectation. They understand what's going to happen. By the time they get to retirement, they know what kind of income they're going to have and they can rely on. And that's all through strategy. And there's somebody who will come at retirement who's never actually thought about it. They've just been working on their job forever and they've been doing their 401k. They haven't looked at it since they started it, whenever they started with their employer. And they say, hey, I'm retired or I'm going to retire. I want to retire. And what can I have? Okay, and so then we try to find out, okay, what is it you're spending? What do you need? But it's all about developing a plan of action to try to mitigate as many risks. One of the risks being selling into a down market, mitigate as many risks as we can so that the person can have a stable income and an expected life expectancy of cash flow that they won't outlive.
So you need to buy time, but at the same time, you also need to provide some form of cash flow.
Well, I need to buy time so that the volatility is not the problem here.
No,
it's the use.
Yep.
And so I want to have enough money on the sidelines because the volatility of the market could work against me. Sequence of returns, Murphy's Law. So I want to have some money on the sidelines to draw down while I buy time, as you mentioned, for the stock market and other assets like that to go through the ups and downs and get to an up. Because if Murphy's Law says the market's going to go down right before you need the money and then I need to be able to draw it from somewhere else. But that also means that the market will come back at some point. But the question is, when will it come back? And I don't have a great answer for that other than it will in time. Now, time may be 7, 8, 9, 10 years. 12
or it could be
years.
7 months.
Or it could be 3 months like we saw in COVID, 2020.
So this is the bucket strategies that you develop and the bucket strategies that you use,
yes.
Professor Plum, are the tools that you use to try to
take advantage of the opportunities that the market gives us.
Explain how it does both of those things. Explain how it buys time, and explain for people who don't know how it gives you the cash flow you need, so you don't have to worry about it.
Well, it feels a little easier now, although it's not easier, not different. It's just we can actually get some return on safer money.
Your bucket one money.
Bucket number one. We want to have enough money on the sidelines to be able to draw cash from to satisfy our income needs for the next 6, 7 years. And that means if I need $50,000 a year, easy math, assuming no return, I need $350,000 in my bucket number one. T-bills, bank accounts, CDs, things of that nature, things that have the appropriate liquidity, meaning I can get to it when I want it without any penalties, and a fairly known, if not higher than cash flow, dollar amount. Now, I don't know if it was what I thought was the definition of liquidity when I got into the industry in the 80s, or whether it has actually changed, or whether I just misunderstood the definition of liquidity in the 80s compared to what it is now. Now liquidity is the ability to turn an asset into cash within a day or something, basically immediately turn it into cash. For some reason, I remember it when I thought it, being able to turn something into cash at a known value, meaning liquidity to me means I can sell a stock at any given moment of any given day, but it might be down 20%, 10%, 15% from what it was just recently.
Okay. All right.
My opinion of liquidity is if I need $10,000 today, tomorrow, next week, that I have an asset that I can turn into that cash, $10,000, and it will be $10,000. It will not be $9,900.
Yeah.
Now, by definition, I'm giving up the fact that it's not going to be $11,000 either. But I want to have enough liquid, safe money that I can draw principal and interest out of from bucket number one. We call it bucket number one, to provide for the income I need over and above my Social Security and pensions to meet my retirement needs, meet my college needs, meet my pick your financial goal need. And I need to have it in time. So if I'm 15 years away from retirement, I don't need bucket number one. Basically, I'm working for the next 15 years. I'm bucket number one. I'm creating the cash flow that I need to spend over the next 15 years. That is the asset that is creating the cash flow, me. But as I get closer to retirement, I'm getting 5, 6, 7 years out from retirement. Now I'm getting into, I'm only going to provide the cash flow for the next 2, 3 years, then I'm going to retire. So I need another asset to pick up the cash flow for a little while after that. Why do I want 5, 6, 7 years worth of cash flow? Because the markets can go down, and they can go down without any expectation.
This is the buying time aspect of the bucket strategy.
You know, and there's times where we say, oh, the market's going to go down. I remember people talking about the market was going to have to crash in 2005. 2006. Okay, in 2007, it tapered off and started to go a little bit negative. 2008, it crashed. But if you didn't stay invested from 2005 to 2007, you missed out on quite a bit of return. On the other hand, I remember back in the 90s, even Alan Greenspan said, this is crazy. But he started, saying it was crazy in 1996. 96 was like a 20% year. 97 was a 20% year in market. 98,
right,
99. It wasn't until 2000 that it actually crashed. So even though Mr. Greenspan basically predicted the dot-com bubble, he just was early. And he missed out on, well, I don't know what he was investing, but he could have potentially missed out on 4 great years of return. And what happens we don't know when it's going to go down. So we have to have that safe money. Now, we also want to have money in the market because I don't expect to die in the next 10 years, 15 years. I'm going to be spending money 15 years from now. And that money, I want to earn a better rate of return than I can get on safe money. So we look at identifying appropriate time horizons, investing with the appropriate investments over that same given time horizon. Stocks are not appropriate, unless you're gambling or speculating, for short time periods. CDs, bank accounts, those are appropriate for short time periods.
Because of that EKG effect of the pattern, I should say, the EKG pattern.
And because of emotion, human emotion. We tend to, if the markets crash, we tend to sell. We don't like that.
Right.
That's when you should be buying, using that volatility to your advantage rather than, to your detriment. So we do create buckets. We do create strategic cash flow. We match our assets and our liabilities. Money I don't need for 15 years. If it drops tomorrow, I wish I would have waited a day to invest. But in the long run, it's not going to make much of a difference.
Right.
But if I need to spend that money tomorrow, that could make a big difference.
I've seen bucket strategies, and I've talked about this before, but I've seen bucket strategies. There are people who put these bucket strategies together. They say, I see the importance of it. Yeah, you really should have some safe money. I think there's no argument that you got to have some safety in case the markets aren't cooperating. You got to be able to draw from that. So they grant you that, which took long enough for people to admit anyway. But they say, okay, so, let's do like 3 years. What do you say? We'll do 3 years. We'll carve off 3 years of safety and put the rest in the stock market. Because if I carve off more than that and the markets go up, as they always do, is what they say, I'm going to, I'd rather have more money working for me.
Okay.
But Professor Plum,
and that works sometimes, but it doesn't work all the time.
Well, so does throwing all your money on number 22 on the roulette wheel. It can
works
work
once in a while.
You know what I'm saying? So
right.
This is where I see the fault lying with some people who call it a bucket strategy when it's not.
And the idea is, and that's where we can get into debates, and it's where buckets is not an exact. Everybody does it exactly the same way. And the time horizons can change depending upon A, where you are in the market cycles, B, who you are financially, and also emotionally, and your individual risk tolerance. Bucket number one may not be 7-8 years. It may only be 5 years. I know that towards the end of last year, 2022, we saw people shortening up their bucket number one because, well, we're already down 20%. So we do the 7 years to protect against the 20% downturn. Well, we've already experienced that. So we're closer to the recovery now, maybe, if they want to look at it that way. And so it's a living, breathing strategy that has to be overseen and managed. But the idea is, how long should you have saved money? The typical downturn historically is about 1.5 to 1 year and 9 months. That's not the time from point A to get back to point A on the market. That's from the top to the bottom.
Then you got to find your
and then
way
you
back.
got to recover. And the typical recovery is several years after that. The trajectory of the line is typically a lot steeper on the downturn than it is on the recovery. And so does 1.5, 2, 3 years of cash, it gets me to the bottom of the market. I haven't recovered yet. I'm still selling lower than I was when I started. Yeah. And
well,
I don't want to do that.
We talk about the bucket strategy, the type that you do here, Professor Plum, dealing with risk. Now, we've established in this podcast that volatility is going to be there.
Volatility is not risk.
Risk, yeah, and volatility will always be there. You can manage risk, though. And when you manage something, can you just say in very quick terms how a bucket strategy could manage longevity risk? Let's just say that. Either living too short or living too long. Of course, living too short, you got insurance, I suppose.
Well, and living too short for the retiree, unfortunately, they don't care after that.
No, I understand.
But they do, and that's something we have to look at is survivor planning when we have a couple, that not only are we looking at how to provide an income during their joint lives, which hopefully will be together for many, many years into the future, but what if one of them, especially one of them, has the pension, goes away too quick, and we either lose the pension or we lose one of the Social Securities? Where's the survivor, whether their tax bracket's going to be? These are all part of planning. But the buckets are all about designing a portfolio to create the cash flow where you don't have to worry about the market crashing overnight, doing 2022, doing a 2007 to 2009 downturn, the dot-com bubble.
So if you live a really long time, the idea is that your income, you still can't outlive your income, your cash flow.
Now, we can't guarantee anything into the future, but there are ways to help guarantee these things. And one of the biggest things that we have to deal with is the behavioral finance side. And how do we keep people from doing things that they know is wrong for them, but it makes them feel better by doing it, like selling when the market's down, basically trying to wrap their arms around, don't lose any more. And so we know from studies that if you have enough income from pensions and Social Security to cover all your basic needs, that you're a better, more rational investor with the rest of the market. But what if you don't have enough money from Social Security and pensions to cover all your basic needs, your rent, your mortgage payment, your property taxes, your insurance, your basic food and gas and electric, things like that? Well, then you can create guaranteed income. And the only reason I can use the G word there, guarantee, is that there is a large corporation guaranteeing it, large insurance company or somebody guaranteeing it. I'm not guaranteeing it. The insurance company is guaranteeing it. So stay with a good one.
So you put the risk on. You
move that risk for that portion of the income to there.
Yeah.
But not everybody needs guaranteed income. I was speaking with somebody earlier today, and between husband and wife, they've got about $9,000-$10,000 of guaranteed income, Social Security and pensions, coming in the door. Their monthly fixed expenses are about $5,000. They don't need more guaranteed income.
Yeah, in fact, we talked about this an episode or two ago, where we talked about protected income and the idea of having that. So to wrap this up, Professor Plum, volatility is not something that can be
is not
avoided.
risk.
It's not risk, and it's not something that can be avoided.
Well, it can be avoided by not
in the markets.
You can avoid the risk of the market or the volatility of the market by not being in the market. But you're also handicapping yourself. You're basically handcuffing your returns.
That's it, because you can have positive volatility, which can work in your favor. Now, risk is just something that you've got to keep an eye on and manage properly.
Risk is using the wrong tool for the outcome you're trying to achieve.
Yeah.
Using the stock market for next week's rent payment.
And I've seen that happen too, by the way. People say, "Oh, let's throw some more money in stocks. I need to save up, and I got a debt coming due in a year, and I need this stock to double in the next 12 months."
Now, there are some people that say, you know what? I'll take that risk because otherwise it's not getting paid without it anyway. I got to turn this, X amount of dollars. I got to do it.
There's risk tolerance, which is a whole other thing. Professor Plum, I appreciate this. I think it's important to clear up the differences between the two, and don't look at risk as volatility, and don't look at volatility as risk.
Correct.
Yes, there is a relationship. Clearly, they do overlap, but not in the way that many people think.
Well, like I said earlier, volatility can be used to your advantage or your detriment.
Well, and that's what the bucket strategy
But volatility, you can't change.
No, that's right. That's what the bucket strategy aims to do. Take advantage of the volatility where you can, and then do nothing about it. Protect it. Yeah, that's the idea. You want to know more about this stuff? Professor Plum, you could talk about this all day. You have.
I do.
In many cases. Anyone at Lucia Capital Group, you can give them a call, talk about not just a bucket strategy. I'll say the bucket strategy, because this is what they've been working on for decades, and people are seeing it. You can see it in action. 800-644-1150. 800-644-1150. Go to luciacap.com, the website. Of course, it's .com. That means, yes, it is a website. Luciacap, LUCIACAP.com. Find all kinds of videos. You got brochures up there. You have reference guides and all this stuff. Things to guide you if you need help on any of this stuff. LuciaCap.com. Don't forget to subscribe. Always subscribe to this podcast. Most of you do. But make sure you get this downloaded to your device on a regular basis. You can go to Apple Podcasts and Spotify. Those are the two places to find this, and don't miss a single episode. Professor, I thank you again, as always.
Very welcome.
Always fun. And look, by the way, over the next few weeks, we may have a couple of special guests joining us.
Oh, good.
Working on it. So stay tuned for that. For Professor Rick Plum, CFP Professional, I'm your podcast host, Johnny Dean. Thanks for listening. Talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. The information contained herein does not constitute an offer to sell or a solicitation of an offer to buy securities. Treasury securities are backed by the full faith and credit of the U.S. government, but are subject to inflation risk. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Insurance services offered through LPL Financial or its licensed affiliates. California Insurance License Number 0518721. Rick Plum is a registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.